Hi guys, welcome to this month's edition of the Zoopla report, where we go through everything in regards to the latest property prices, mortgage rates and everything that's going on between the north and the south of the border. But importantly as well, we're going to add something this month. There's another article that's just come out today. It's really important to add this article in against the backdrop of what we're seeing in the overall property market. So look, let's have a little look. Rental prices. Now this is important because our business is all about investment, and it's all about the clients making the most amount of money that they can possibly make. Now, if we look at it over a 6-month or a 12-month period, do we make as much money today as we did 12 months ago, 2 years ago? The answer is no. Why? Well, because the mortgage rates are higher than they were. Simple as that. You've got to factor that in. But two things. First of all, if you're a cash buyer, you're probably in one of the best positions you've been in for years to buy a property, because one, property prices have fallen, but two, the rental rates are still going up. But if you are a mortgage buyer, well, it's still a perfect time, because you can go and get a discounted property that's off plan, wait for 2 or 3 years and potentially get your mortgage in 2 to 3 years time when they're looking at rates to come back slightly. But in terms of the rental growth, it's there. Rental growth is set to hit 25% by 2026, so a few years time. So it's got here rental predicted to rise over the next coming years, outpacing house price growth in the same period by more than 4 times. So what you've got here is house prices are still forecast to increase by 5.5% over that period. I think it's going to do a little bit more, but anyway, over that period. The reality is you've got rent dramatically increasing. Now, we've got projects where we're comfortably making 7 to 8% rent now. That's on a traditional let, and higher if you do a short-term let. But let's talk about traditional lets. Well, if you're making 7 to 8% on a traditional let and 2 to 3% a year on the growth, you're still making 10%. And don't forget that 10% is on a larger amount than you would do if you were just cash in savings. Because why? Because you can leverage. So if you've got 50,000 cash and you put it in a bank at 5%, you make 5% of your 50,000. Well, if you've got that 50,000, you can go and borrow 150. Yes, you might have a 5 or 6% mortgage, but you've still got 7 to 8% of income coming in and a few percent of growth as well. So it easily outpaces what you're paying in the mortgage. So the reality is that there's great gains to be had in this particular market, and great bargains to be had. But look, let's head over to the house price report. Well, look, if we head up to the headlines, the most important thing, we're pretty flat for the year, as you can see. You know, from August 2022 to 2023, we are marginally up 0.1%. In terms of sales, we have seen decline in sales completions. Why? Well, typically because a couple of things. Mortgages or lenders have been sort of playing hardball over the past few months. That's held up a lot of completions. That's the first thing. But another thing is less people are buying property, or less people are moving. Now, there's 2 types of categories. You either have a residential client. What are they going to be doing? They're going to be sitting on their hands. They're either going to be trying to remortgage and trying to get the best rate they can, or they're going to simply be waiting, especially first-time buyers. But investors, actually, who are in position of cash, they're the ones that are taking up a large chunk of the market at the moment. But we are going to naturally see a decline in completions. However, we're comparing it to the peak. 2022 was a great year for property. 2021 was another great year for property. So if you compare it against those 2 years, it's a bit of an anomaly. We have to go back to 2019, the last time that the market was, as it should be, before COVID, etc. And we're actually still trending exactly as it was back in 2019. So we've got no major issues or concerns. And affordability has actually improved. Why? Well, because the property in the south of England has actually fallen. Still going up in certain parts of the north of England. We'll come to that later. But the reality is that in the south of England, property prices have fallen. So therefore your affordability has improved. But if you look here, housing transactions are still on track for over 1 million completions in 2023, which is fantastic. So as we go down, look, you can see here, the market activity, as we said, continues to track in line with 2019 levels, but well below the levels recorded over the pandemic years. That's a given, as I said, because they were years totally out of context. 2020, quiet. 2021, 2022, booming years. So the reality is we can't take those as a normal year, but we have to head back to 2019, and we're still tracking as expected. The demand for new homes, again, because we see a lot of first-time buyers for new homes, but demand for homes, lower than the average compared to the same period in the last 5 years. And sales are down to a lesser degree, but the availability homes for sale has rebounded after a long period of scarcity. Again, that's why we're seeing things track back slightly as well. But this is quite key as well. What we're seeing here is where prices are falling and where prices are increasing. Well, you've got prices here in the southwest, the southeast, eastern and London. Again, you can see here that they're all diminishing, whether it's 0.8, 0.9 or 1%, but we're still seeing growth in certain parts of the UK. So if we head to where we typically look to buy, especially the northwest, you're still seeing 1.2% increase here. Yorkshire, West Midlands, northeast, we've still got a fair decent bit of growth there, and I think year on year we will still see 2 to 3% in those particular areas. What you will see as headlines is you'll see 3% falling or 5% falling over the last 6 months, but not in the areas where we're looking to buy, just simply overall. But what that does, and the favour that it does for us, is because developers are reading the same headlines that you are, even though that the market's going up in areas like Liverpool and Manchester, we're actually getting better discounts there now than we were 12 months ago. You've got here 34% buyer demand over the last 4 weeks versus the 5-year average, standard stuff. But this is important as well. The southern regions register the larger price falls. We know that it's the lowest annual growth rate over 12 years since August 2012. It's the lowest growth rate that we've had in the south. The market got too overheated. You combine the overheating of the market with the high interest rates, and you're bound inevitably to have a fall in sales and a dip in prices. It's as straightforward as that. But what we do think is where the market is going to hold up is, as you can see here, it's holding up, one, where first-time buyers are going to buy. That's the first thing. You've got first-time buyers typically account for 1 in 3 sales a year, and they all they originate from the private rental market. But what you'll see here is the dynamic of the rentals are changing. Because why? Well, because what we're seeing is first-time buyers aren't buying as many as they typically would in certain areas. Manchester is heavy in terms of its pricing, comparison to what the average wage is there. So what do? They rent for longer. That then pushes up the rent, as we saw on the article before. And of course, it means better income and better yields for you as an investor. What you'll then see is, in terms of the, as you can see here, in Scotland and the northeast, the average mortgage repayments are 18% lower than rental cost. So of course, it then makes it makes more sense to actually in those areas to buy. But where you've got areas where it actually the rental costs are cheaper than the mortgage cost, they will continue to rent. Again, it's just common sense. So if your mortgage is going to cost you more than your rent, well, what do? People simply are going to rent for longer. And that is happening in areas like, as I say, Liverpool, Leeds, Manchester, Sheffield. That's why we're still seeing great demand in those areas. Now, 10% here, you see how much UK rents are lower than mortgage repayments for a renter buying in the home that they rent. So that's why they're sticking with the rental areas. And again, this chart here just compounds that. But what you're going to see here is we're still on track for 1 million in terms of sales completions. Yes, it's down 23%, but we are comparing it year over year. And okay, it's going to be the lowest number of sales since 2012. But what you have to understand from an investment perspective is, when do you want to buy? Do you want to buy at the peak of the market, or do you want to buy when the market's tracking back? Well, a lot of amateur investors, they start to actually think about selling when the market's tracking back. Ironically, you want to be selling at the peak, and you want to be buying. If the market's tracking back, go and bid. Go to a developer. If they're charging 200, go and bid 180. See what kind of deals you can get out there. Because if you get a great deal, it's still a great time to buy, especially as an overseas client. You've got a weak pound in comparison to the AED, the dollar. The reality is that you're getting a better bargain now than you would have done 12 months ago. You're potentially saving 15 to 20% if you include the price falls and the exchange rate in that as well. Now, where should you be buying? Well, look, let's head down to the chart here. You can still see that Edinburgh, Nottingham, Birmingham, Sheffield, Manchester, Leeds, Liverpool, the properties in the north, the house prices in the north are still making great gains. Not as good as they were, but again, we're now back to normal gains rather than the 5 to 10% that we were seeing. And in terms of actually what you're seeing here, that overall the UK house price ratio was 6.3 times earnings at the end of 2023. Now, what that means is it's expensive to buy a property in the UK. So this really plays into the hands of investors, because if you can get a discount coupled with the fact that high rents because people aren't buying, then you're onto a winner. It is as straightforward as that. So look, without further ado, have a look at things, do some research. Don't just take our word for it. Have a look at research reports, what's happening still in Manchester, how much money is being spent, what's happening in Liverpool, and I can assure you there's a bargain to be had for you. Take care and I look forward to seeing you soon. Bye-bye.